Welcome to The Real in Real Estate, your gateway to the source. I'm so glad you're here. We're all about diving into the nitty gritty of real estate, sharing insights, tips, and some awesome interviews straight from the industry's beating heart. From the latest trends to cool investment strategies, we've got you covered. Let's explore and uncover all the essential tools and knowledge you need for navigating the ever evolving world of property and housing. Here we go. Welcome back to The Real in Real Estate, where we talk to the experts, get the facts, dispel the myths. And today we're here again with Chad Helmcamp of BWC Lending. Thank you so much for joining us again, Chad. I really appreciate it.
Thank you for having me. I'm excited to be here.
Well, I know you've been on the podcast a couple of times before, but just give everybody a little background and how you ended up with this is your own company, BWC Lending, correct?
Yes, ma'am, that is correct. So, yeah, I've been in the business since 2003. So, going on my 22nd year in the business.
Wow.
It's been a great ride. As I always tell everybody, I don't think anybody ever grows up and says, "Oh, I want to be a realtor or a lender when I grow up." But once you find this industry, it's really hard to imagine yourself doing anything else. And that certainly has been the case for me. So, found my way into the mortgage business in 2003, started BWC Lending in 2019, which was really great timing because rates were on their way down and we had a really great 3.5 year run.
Yes.
Then all the COVID stuff eventually caught up to us. Rates started going up in 22, and we've had about a 2.5 year stretch of not so great rates. But
But they're
for
getting
the first
better.
for the first time in 2.5 years, we have good news to talk about. So
Yes.
that's why I'm happy to be here today.
And that's why we're here because the rates are going down. They're actually at a point now where I remember when they got to this number, or what it was last week, people were refinancing like crazy because it's such a good rate. And historically, it is a good rate. Am I correct?
Absolutely. As a matter of fact, in 2003, when I started in the business, that was the first time rates had dropped below 6% in 50 years. And
50. Wow.
yeah, and then of course, most of my career, they've been probably below 6%. But now, after having touched almost 8% last October, they are now, depending upon the circumstances, low sixes, high fives, depending upon the particular individual. And for government loans, rates are in the fives. So it's not a bad time for to be buying a house, that's for sure.
No, it's not. No, it's not. 6%. Well, we've come down to, we're going to round it off. We'll say 2% in the last 12 months, right?
That's about right. Yeah, it's about 1.75 to be exact,
Mhm.
but yeah, almost 2% in the last 12 months is a substantial improvement, making a very big difference for a lot of families.
Well, let's put today's podcast in layman terms because we need to for me and
Absolutely.
everybody else. But I guess basically what I wanted to ask is we know where we were, how we got there, where we are now, and where you think you're going. Now, I know I didn't ask you to bring your crystal ball, but anything you can give us would be great. I mean, I'm happy with the 6%, but it'll never be
Sure.
2, 3, and 4% again. I don't think. I think that
I
was
would
an
agree.
anomaly.
I would agree with you. I don't think we will ever see twos and threes again. We probably never should have seen the twos. We've
Probably, yeah.
we've seen threes a handful of times over the last 20 years. But in the environment we had been in where inflation was pretty tame, it wasn't a terrible thing. But I think with the size of our government debt and the size of the government deficit, most people believe that there's very little room for rates to improve much more.
Okay.
And so, as a matter of fact, if you look at all of the projections for Fannie Mae, the MBA, and then Wells Fargo, those three entities came out with their projections for where rates would be at the end of next year. And the average is anywhere between 5.9 and 6.1, which
So
is
we're
sort of
here.
which is sort of where we are right now. And
Yes.
so, and right before I hopped on this call, I follow Lawrence Yun pretty closely from NAR, the NAR economist, and he said that he predicts that they will be around 6% by the end of 2025, basically meaning they'll be about flat. He said maybe if we're lucky, they touch 5.5. So maybe there's room for a little bit of improvement,
Mhm.
but I don't think it would be substantial. So maybe another quarter to a half improvement in rate might be the most that we'll see over the course of the next year.
So everyone should stop waiting and buy now. Or buy, I mean, not be afraid to buy.
Absolutely. Yeah, I think now is a great time to consider it. As a matter of fact, reading an article this morning saying that apparently the first week of October has over the last couple of years has proven to be the best time for a home buyer to buy a house. Not really sure
Interesting.
what data they're pulling that from, but they said the first week of October apparently is a great time to buy a house. Obviously, more inventory and things like that in the spring and summer, but they're saying there's less competition at this time of the year, so you tend to get a little bit better deal when you make an offer on a home.
And you know what? I sell houses all year long. You do loans all year long. So yes, spring tends to see more people put their house on the market simply because they're trying to get it sold so they can move at the end of the school year. But I sell houses all the way up to December 31st. It's really not, there's nothing wrong with that. I bought a house one time as a side note, and I think we moved on December 20th. And my kids were little, so I not only did I have to move and unpack, I had to put up a Christmas tree before the 25th just so we could have Christmas. So people buy all year long.
Absolutely. Yes. People do buy all year long. And just on a side note, like so been tracking everything over the last couple of years. Right now, we October will be our best month in over 2 years. So
Wow.
it is very, very busy. We're absolutely getting more phone calls. I think this is the beginning of that wave of people who've been sitting on the sidelines for the last couple of years.
Right.
I think 2025 is going to be one of those years for us in real estate that we look back on and go, that was a darn good year. So I'm looking forward to it. I mean, obviously, it's so much better to be giving people better news. It's still
Yes.
hard for some people. They still think about the twos and threes and 4% rates. Uh, but I think the longer we get away from those years, the more accustomed people will get to the fact that this is our new normal. And I think moving forward, good rates will be in the fives, high rates will likely be in the sixes. And I think that's what people will start to grow accustomed to.
Right. Yeah, I hope people are not waiting for two, three, and four to come back because no one says it's ever going to happen again. It was an anomaly. And if you really believe in your heart that it's going to happen, go ahead and buy now. You can always refinance. Chad or anyone will help you refinance. Don't lose out on your dream home. Don't wait for something that may never happen, probably won't ever happen.
Absolutely. And I think that's the thing. Like even now, we have people that didn't time it perfectly and they bought in October when rates were north of 7%. And we've already started talking to some of these folks about refinancing. And one
Yes.
individual in particular worked up the numbers. It was going to save her $900 a month. But of course,
Substantial.
it's substantial. But in her mind, she thinks it's going to improve further. For her sake, I hope she's right and not wrong, because if she's wrong and rates go back up, she'll be really kicking herself.
She'll be
Um,
disappointed.
because I think at the end of the day, you have to look at your refinance options when that time comes. And if it makes sense for you, you know, it's one of those things. It's hard to, sometimes people get a little too greedy just
Yeah.
because rates have improved so much and they think they're just going to keep improving. But we've already seen rates pretty much level out. I would say around September 11th is where rates sort of kind of bottomed out. And then we've been sort of inching up just a little bit. But those were the best rates we've seen in some time was September 11th.
And I see more listings. I check the report each week. I see more listings coming on every week, which is good for a buyer. It's good for a seller too, because it's still leaning toward a seller's market, but there will be more inventory out there for the buyers to shop. And with the good rates, now's a good time to buy.
Absolutely. Yeah, I think it's getting a little bit better every day. And as the inventory picks up, I just saw that graphic earlier too, that the number of days on market is growing, has grown each and every since
Mhm.
22, 23, and now 24. So as that time on market increases, the inventory will increase as well. And obviously the more homes that are available, the more home buyers are going to come back into the marketplace for sure.
Right. And I think it's time for the sellers, correct me if you disagree. I think it's time for the sellers to get realistic about the price that they're listing their home at, because before it was like the sky's the limit. There really was no limit. Whatever you put price on, somebody was going to buy it. That's not the case anymore. Price your home intelligently, make sure it's in good shape, and it's going to sell.
Absolutely. No, I 100% agree with that. I mean, I just talked to someone this past week who they listed in the Heights and they listed it at a price of what they wanted, right? Like they said, if we get this, we'll be happy. But it was a respectable price. And what did they get? $50,000 more than what they asked for.
Yeah.
And I just it's so often that I see it that a seller prices it too high and then it sits and doesn't sell, as opposed to if you price it right, it attracts the buyers in, you get them
Absolutely.
competing for it, and then you end up getting more than you anticipated. So
Right.
every market's a little different and you got to
Right.
find that sweet spot of what that looks like. But I think it just makes so much more sense to price it that way.
Right. Talk to your professional realtor and
Yep,
listen. Now,
absolutely.
you had mentioned earlier, the rate, I think it was 6.08 I saw last week, but you said it depends on the person. So what does it depend on for some people to get different rates?
Yeah, so first and foremost, I would say every loan program is different. So you've got
Sure.
conventional Fannie Mae and Freddie Mac loans, you've got conventional non-conforming jumbo loans, which is any loan amount now that depends on who you're talking to, but for most cases, it's going to be any loan amount over 766, 500. People are already projecting that number to change to be in the low 800s at the turn of the
Oh,
year.
wow. Okay.
So jumbo loans are that number keeps moving up.
Right.
Then you have FHA and VA. So FHA and VA are our government loans and USDA technically. I personally don't do USDA loans, but
Mhm.
FHA and VA, those rates tend to be in the low to mid fives. So they're very, very good. And they're not as credit score sensitive. So you can have some credit score challenges and still get a great rate with the government loan.
Great.
But the loan limits on FHA are under 500,000 right now. The conventional conforming loan, again, is going to be any loan amount under 766, 500 today and probably around 800 at the turn of the year.
Yeah.
Those loan programs are very credit score sensitive. And so to get the best rates for those programs, you have to have a 780 or better credit score. And then every 20 points it drops below that, you'll see adjustments to your interest rate. And so you mentioned the rate being just a little over 6%, 6.03 or 04, 08, something like that
Something
last
like that.
week.
Yeah.
And that's Freddie Mac's weekly survey that comes out every Thursday. And that rate takes an average of all the conventional conforming loans that are sold to Freddie Mac or locked with Freddie Mac as of that week. And so, anyway, so that's the lowest it's been in almost 2 years. And so that's the average of everything. And so what you'll see, so if a client right now really wants to pay points to buy down their rate's likely going to be in the mid to high fives, 5.625, 5.75.
Okay.
And then if they don't pay points, they'll probably be around 6.125 or six and a quarter. And so when you take all of those people that chose those different options and average it out, that's how you end up at the rate just a little over 6%.
Okay. So it's important to have a good credit score, obviously. Okay, 780 is what you said. If someone's below 780, they're just not sure if they can buy a home yet or they can qualify. Is it a good idea to go ahead and contact you or another lender and help them figure out what they need to do and how they need to do it?
Absolutely. And I tell people this all the time, the sooner the better.
Yeah.
And, I had a client yesterday who reached out to me in July, said she wanted to get pre-approved, but didn't finish that process until just this week.
Oh, wow.
And so we lost 2 months. I pull her credit. We identify on her credit an old account that had derogatory items associated with it that was associated with her ex-husband.
Oh, no.
Um, and so for her score would likely have been definitely above 740. It might have even been above 760, but that one derogatory account caused her mid score to be around 715.
Oh, wow.
Still a good score, but I showed her that it was going to impact her interest rate by about 3/8, which was going to be about $60 a month for her loan size.
Okay.
And so, it's a meaningful difference. And she may still have time to fix it, but if she finds a home next week, there's probably not going to be anything we can do about it.
Yeah.
Um, but because it's not her account, she can actually get it removed from her credit record and her score should go up a minimum of 30 to 40 points.
Oh, that's a good minimum. That's quite a bit.
Yeah, it can make, and for some people, if you look at a derogatory account, it can move it as much as 80 to 100. So it really depends on what it
Significant.
is. And that's why I always tell people 6 to 12 months before you're ready to make an offer, talk to a lender, have them check your credit, make sure it's a lender that will actually review your credit with you so they can, when I do it, I go through a what if simulator to show them exactly how it will impact her score or their score. In her case, it was going to go from like 717 to 747 just by getting that one item removed.
Well, that's incredible. And I can testify, Chad will go over everything with you. He'll do it on a Zoom call or person to person. You will not have any questions by the time you're finished. So if Give him a call. And
Thank you.
he's got a weekly newsletter. So if you want to know more about it, you can sign up for his newsletter too. I read it every week.
That's right. Chris does a great job with our newsletter. It has a lot of
Yes.
great information, and I find people sharing it on social media, et cetera. So there,
Hmm.
because we share the Freddie Mac survey, and it's 6.08 as of last Thursday. Um, and so we share that on there, but there's always good information there for home buyers and home sellers for that matter.
So, off the top of your head, what else do people out there need to know about the market at the moment?
Uh, they
Anything
need to
else?
know they need to know that when the Fed cuts rates next time, it's not likely going to impact mortgage rates very much.
Okay.
Um, the Fed has very much forecast what they're expecting. They produce what's called a dot plot, which shows their projected interest rates from all the Fed members. And they do that through the end of 2025. And as of this moment, they are projecting a total of 200 basis points or 2% in the reduction of the Fed funds rate. And the Fed
Okay.
funds rate impacts short-term rates. So think what you get paid on your money market savings account, think what you pay on your credit cards, basically any short-term rate, that's what the Fed impacts. What the mortgage market looks for, they do look at what the Fed does, but they're trying to anticipate what is the economy looking like. And so
Mm.
when the Fed said they're going to start cutting rates, when everybody was projecting they were going to cut rates, the market already started improving. So if you just look at the last 90-day improvement on mortgage rates, it was way more. Like we said, we're down almost 200
Yeah.
basis points, and the Fed's projecting that through the end of next year before they catch up. Um, so now it's going to be more about what does the Fed say as much as it is about what they do. So if they start to change their tune to where they get concerned about the economy, then in that case, we could see rates improve further. But right now, they think the economy is still strong. They think inflation is headed towards 2%, which is where they want it. And they're saying that they're planning a slow and gradual reduction in the Fed funds rate towards hopefully something that's closer to around 3 to 3.5%, whereas we were around 3.5%, where we were around 5.25% when we started this.
Okay.
Um, so we'll see. So I would pay close attention to any economic numbers that come out. This Friday, we've got a jobs number coming out, and that's what people are looking at. If we see weakness in jobs, then in all likelihood, all the people who are predicting what the Fed's going to do are going to predict that the Fed may continue to cut at a more aggressive pace than maybe what was initially thought. And so anytime there's a shift in the economy, stronger or weaker, that's when you'll see mortgage rates respond. If all of a sudden the economy looks really strong, rates are likely going to tick back up. Um, but this week we have a strike in the ports, and
Yes.
which is expected to impact the economy in a pretty big way. And the
Yes.
longer that strike goes on, it's not definitely inflationary. And so if we start to see inflation tick back up, then that could slow down what the Fed does as far as lowering rates, because inflation is the main thing that they don't want to get out of hand.
Well, at this point, I'm just hoping it doesn't go up. So if it stays at 6, I'll be happy.
You and me both. I think actually, if we trade between 5.5 and 6.5, I think we can sort of operate in that space. But it's been flat since September 11th, so almost 3 weeks of sort of flat
Yeah.
rates. It's so much easier to work in that environment because I don't have to give a client bad news every day. When rates were going up for two years straight, it was just every time a client would call back, felt like I was
A
giving bad
different
news.
number.
So
Mm.
it's nice to be able to be more consistent in what we quote.
How long can you lock in a rate? Or does that vary depending on?
It varies. I mean, every lender has different options. We have one lender that will allow you to lock a loan for up to 120 days.
Mm.
Historically, I'm not a big believer in locking for a very long period of time because, first of all, when you lock for that long, you're usually paying a premium right from the outset.
Mm, okay.
So that's number one. Obviously, if you go back to 22, anybody who did a long-term lock looked really, really smart, but no one could have predicted what rates were about to do.
Right.
But those who did buy in 22 are actually sitting on loans that may never be refinanced because most of the people we closed in 22 had a rate sub 6%.
Mm.
And you'll remember summer of 22, that's when almost everybody moved to the sideline, said, I'm going to wait for this to pass. And
Yeah.
here we are 2 years later. So
Okay. Well,
those that
now you
didn't
don't
wait,
have to wait.
that's right. That's right.
So, Oh gosh, I just had a question. Assumable. People keep asking me. Most loans are not assumable. Is that correct?
That is correct. Yeah. So conventional loans are not assumable. The only really assumable loans are government loans. FHA and VA loans are assumable. And there's, usually when you get into the details of assuming those loans, it rarely works out. Uh, Simply because if you think of it this way, let's say the FHA loan you want to assume has a $200,000 balance, but the seller of that home is selling it for 400. So
Uh,
unless you as the buyer have a $200,000 down payment,
yeah,
that
it's
deal
not going to
goes
work.
south quick because there's not a lender anywhere that's going to allow you to finance that additional 200,000 somewhere else.
Right, right.
There's no incentive for them to do that. So if you've got a very cash rich buyer buying a home where on a loan where they can assume it, then it's a nice situation.
And for everyone else, just move on and enjoy your 6% or
That's
five and a
right.
half or whatever it is at the moment.
That's right.
All right, well, I think we're getting close to the end of our time here, Chad. Give everybody your contact information. If there's any last snippets of wonderful information you want to give us, please do.
Absolutely. Again, Chad Helmcamp, BWC Lending. Best way to reach me is my cell number, 713-826-8136. You can go to our website, bwclending.com. And you can also follow us on Instagram. Our Instagram handle is BWC Lending as well. And we share lots of funny and interesting things on social media. Not always
Yes.
all that valuable, but funny and entertaining. So I'll
Well,
take that.
we need a little funny once in a while, don't we? We will have
Absolutely.
all of your contact information on the podcast as well. But I wanted to make sure everybody heard that. So, well,
Awesome.
Chad, thank you again. As always, you've got all the answers, and I love working with you. So I really, really appreciate this time that you spend with us here.
Well, thank you very much. I appreciate you having me. And I think what you're doing is great. I think your podcast is fantastic. You've been sticking with it, which is fantastic. And
Right.
for those of you who are out there looking for information, please keep tuning in to Jean. She'll share a lot of great insight with you.
And we talk about lots of different subjects, but mostly about real estate.
Perfect. Good.
All right. Well, thank you again, Chad.
Thanks, Jean. You take care. You have a great day.
Bye. You too.
Bye-bye.
Thanks for tuning in to The Real in Real Estate, your gateway to the source. Be sure not to miss our upcoming episodes loaded with fantastic insights, expert tips, and all the latest trends in the property scene. Don't forget to stay connected with us on our Trilogy Realty Group socials: Facebook, Instagram, YouTube, and even TikTok. Until next time, take care.